up, guys? Welcome to Joy of the Trade. This is a post-Fed reaction video. I'm going to talk a little bit about what the Fed came out and did yesterday, what they said, what was surprising, what was shocking, and look at some charts as usual. So yesterday, I was on a roundtable with Roger Scott where we discussed how this Fed has been incredibly telegraphed in what they're doing. And they just did it. They just took it to a new level with yesterday's FOMC meeting. They telegraphed exactly their expectation for GDP growth. They gave you a synopsis of inflation that they care about and don't care about. They took this amazing flexibility with looking at inflation averages, which is always going to be looking backwards to react to. And so what they said, what they did in essence was they went extra telegraph and said, we are not going to raise rates no matter what, no matter hell or high water. We're making a bet. We're making a bet that inflation isn't going to spike to dangerous levels. We're making a bet that commodities aren't going to go up 300-400% and cause incredible pain in the economy. We're making a bet that tech companies won't go out of business because of interest rates being here. The Fed went all in yesterday. And I think personally it's a little naive because the market likes the tantrum. We're seeing already this morning a little bit of a negative reaction. I'm filming this pre-market, but I think it's a little naive because the Fed isn't, I think they got a little bit too cocky, if there's a good way to put it. I think they got a little bit too cocky because they've been creating bubbles, not giving a hoot about, and dislocating all sorts of prices and assets around the world. And invariably the stock market's been okay, but let's see what happens if the stock market's not okay. So let's look at some charts that I really care about right now. Check this out. This is a long-term 20-year. This is the S&P 500 in yellow here. Like perfectly bullish parabolic move happening lately. And this is the 10-year yield. This is the most important yield in the world. This is the yield everybody watches, the US Treasury 10-year. I was talking about it like 170, 175 as being an inflection point. We're here at 175, and markets look like they're going to puke this morning. We'll see if they hang here. If they keep pressing, what's going to happen to markets? I think all stocks get whacked. We've had a bit of a strange move because if you look since 2009, and if you look at the yields then, we were near 4% on the 10-year Treasury. And we started coming lower and lower. So we've been in a downward trend in the 10-year. It's basically since the great financial crisis, if you will. And the S&P 500 has gone from 1,000 to 2,000 to 3,000, now 4,000, as yields have gone lower. So now we have this huge spike. We have this huge spike in yields, and the stock market is keep going higher. So this move down was rocket fuel for the market to go higher. Now rates are coming up. Will that continue to be rocket fuel? I don't think so. And I think that the Fed is being a little bit cavalier with saying, we don't care about the bond market. We don't care. The big thing that they're not realizing is that this move wasn't led by banks. This is not a commodities move. This is tech. This is an innovation move, right? This is what's happened with this. Housing, cheap credit. You start to make credit more expensive. Growth becomes pricier. Growth becomes almost impossible. So I think the Fed is going to capitulate if yields go to 2%, if you see a 20% correction in the stock market. And I think this game of chicken, they took it a little bit too far. They went a little bit too cavalier, and I think it's actually going to backfire. And I think it's going to be a lesson for future Feds to not be so transparent, to not be so cavalier, because what you say, what you do has effects. People get carried away with this stuff, and a word can create inflation. So we'll see what happens. Just my 2 cents. It's going to be a rock and roll market. There's going to be tons of stuff to do. But if you don't know how to trade the short side, if you don't know how to trade pairs, check out the money links. If you don't know how to trade really short terms, I highly recommend this burn notice. I have a pair trade strategy. Then I have the burn notice, which is a fade strategy. So we're looking for fade opportunities every day. And, just to be active in this market, because this is going to be a market that flops around. You're already seeing it. You're seeing these moves. These are great traders moves, very difficult investor moves. So LFG guys, I'll be back with more. Let's see what happens with the Fed and keep a close eye on these interest rates on these 10-year yields.